Feeling heart pain having to pay high income tax every year? In this video, I'm going to teach you how you can save on income tax using the Supplementary Retirement Scheme, in short SRS, and the important things you need to know using this method. SRS is an account in which an individual can open voluntarily to save for retirement and above CPF savings. Benefits of contribution to SRS is that all contributions are tax-free and investment returns are tax-free before withdrawal. Only 50% of the withdrawal amount are subjected to tax. Let me narrate an example for you. Let me illustrate using an example of Charles. Assuming Charles earns $95,300 annual income, and he contributes $15,300 to SRS. His taxable income will be $80,000. He could have saved $1,759.50 on tax. This is because of the 11.5% tax bracket for this $15,300. In 20 years, he would have saved a total of $35,190 through this example. The maximum SRS contribution for Singaporeans and PR is $15,300 and for foreigners is $35,700. However, there are disadvantages on contributing to SRS. That is, if withdrawal were to take place before 62 years old, there is a 5% penalty fee and 100% of the money withdrawn are subjected to tax. There are special circumstances in which it will be penalty-free, for example, due to medical grounds, or due to terminal illness, or due to bankruptcy, or due to a foreigner who has held an account for at least 10 years and has been a non-Singaporean for a continuously of 10 years before the withdrawal. Therefore, you need to ensure that you do not need to withdraw the money before age 62 in order to contribute to SRS. I'd like to introduce you two magic numbers that you need to remember. The magic numbers are 400,000 and 10 years. So for the sake of easy illustration, let's assume that there's no interest rate on this 400,000. So let us use back Charles as an example. So assuming Charles, for the first scenario, if he were to withdraw $40,000 each year, which means half of it is $20,000 supposedly to be taxable. But because it falls within the zero tax bracket, he do not have to pay any income tax. And he continue to regularly withdraw this amount. So at the end of the 10 year, he would have withdrawn $400,000 and half of it, which is $200,000, which is withdrawable. The second scenario is if he would withdraw $80,000 at the first year, half of which is taxable, which is $40,000, which means the income tax to be paid is $550,000. And if you don't withdraw regularly, 1 year he withdraws and the next year he don't, the year he withdraws and the next year he don't, at the end of the 10 year, similarly he would have withdrawn $400,000. But the amount taxable will be $200,000, and because of the way he withdraws, the total income tax you have to pay is $2,750. Now let us take a look at scenario number 3. So assuming he wants to test the system, at the first year he withdraws $40,000 and half of it taxable, which is $20,000, which falls under the zero income tax. And he forgot all about it. Only at the end of the 10 year, then he realized that he have not withdrawn his money. He would have to pay a $17,560 due. So if we to look at how the different scenarios of withdrawal strategy comes in, the first scenario will not need to pay any tax. And the second scenario, a $2,750 to be paid. And the last scenario, a $17,560 to be paid. So this concludes that it's very important how the withdrawal is being withdrawn during the withdrawal years. Someone who earns more than $40,000 can consider contributing to SRS. Let us take a look at Lucy as an example. Assuming she earns $40,000 and her income tax will then be $550. Assuming she's being approached by another company and her income increases to $50,000, then her income tax would then have an increase to $1,250 because of the 7% of that $10,000 additional, which means there is now a difference of $700. Let's say she used this $10,000 and contribute to SRS, which means her taxable income will then be $40,000 and her income tax will then be $550 as usual, and which means she will have saved a $700. And if you put it another way, she has earned a 7% on that $10,000. There is a maximum income tax relief of $80,000. So if your total personal relief is $80,000, for example, if you are a high income earner with few children, then probably contributing to SRS will not benefit you. I'll be showing you how you can calculate the tax savings that you'll be saving using the tax calculator that is on the IRAS website. You can Google tax calculator and click on the first one on IRAS. Click onto the latest tax calculator, in this case 2021, and you'll be brought to this tax calculator. How you can use it is you can key all the following details according to your latest notice of assessment. For example, you can key in whatever the income that you have and whatever relief that you have. So over here you will notice that there's this net tax payable, which is the amount of tax that you have to pay, and under here under the Supplementary Retirement Scheme relief, this is where you toggle the amount of contribution that you can contribute to see how much you can actually save on your tax. So based on this, you can then determine how much you should contribute to SRS. Currently, the withdrawal age is at 62, and in next year it will increase to 63. I believe it will increase to 65 and eventually to 70 by the year 2030. So even if you are not ready to contribute to SRS, I think it's a good idea for you to open an SRS account and just put in $1 in order to lock in this withdrawal age at age 62. Therefore, after when you are ready, you can then contribute to SRS account. One thing to take note is that once it's past the prevailing retirement age, and when withdrawal has started, the person can no longer contribute to SRS. So this is something important that you need to take note of. Assuming you open an SRS account, but do you know what is the interest rate for that? It is only 0.05%. Therefore, it's better that you open an account and allocated the funds into other financial instruments. As you can see from the stats from SRS, that there's still 26% of account holders who still put the money inside the account and not relocate it into any other portfolio. There are various instruments in the market, like some investment instruments like Singapore saving bonds, stocks and shares, or even unit trusts. It is important that you monitor regularly and do regular rebalancing in order to maximize its returns. What rebalancing actually means is, for example, in an initial portfolio where 60% into equities and 40% into bonds, and when there's a bull market, naturally equities will perform better. And when that happens, let's say 20% is being sold in order to reallocate back the portfolio to its original allocation. The same also happened during a bear market where bonds will perform better in this case. And when 20% is being sold to take profit, that's when the initial allocation will go back to normal. Through this process, there will be a maximization of returns and in a way buying low and selling high. Another option is to go into retirement plans. There are single premium or a recurring premium in which you contribute a certain sum of money and let it accumulate for a period of time, and you will get a guaranteed stream of income and some component of non-guaranteed income during your retirement years. Usually for higher returns are not guaranteed. And for returns that are guaranteed, the returns are lower. So to decide which to select, it all depends on your overall portfolio. If you already have guaranteed returns, it is better that you go for some investments, and vice versa. Your time horizon will also determine which is the better selection for you. SRS in a nutshell means you contribute a sum of money into SRS that is fully taxable. You can open an SRS account with any of the 3 local banks, and you can either leave it at a deposit rate of 0.05 or put into a wide range of instruments approved under SRS, or into single premium endowment plans or annuity plans. From age 62 onwards, you can then either do a lump sum withdrawal or a withdrawal spread over 10 years. And of course, 50% of the amount withdrawn is subjected to tax. It's the end of my sharing. I hope you have benefited from this session. If you have benefited from it, help me to like and share with your friends whom you think might also benefit from this session. I'm thinking of creating another video on retirement planning. Leave a comment and let me know whether you'd like to know more about retirement planning, and if there's interest in it, I will then create another video on retirement planning. Thanks for watching!